Let's talk Chapter 16 problems. On the left-hand side of the screen, I have problem 16-1. We're going to cover 16, 1, 2, and 3. Then I'll show you something just like the required problem for Chapter 16. By now you should have read the chapter, listened to all the previous lectures that I put out there, maybe skimmed the PowerPoint. And you should know what the AFN, or additional funds needed equation, is by now. If you need a refresher, go to and look at page 573 of your chapter, and that explains the equation. There's three parts to it. They walk you through all three parts, what each part is trying to figure out for us, and then what the answer means. So just to summarize, the additional funds needed just means how much more funds does a company need to continue growing, essentially, is the way to think about it. Just know that a company in lower growth mode that has excess capacity may not need extra financing. They might just generate enough internally to cover that. A company that's growing fast and maybe is already at or near full capacity would need some financing, most likely, and the question is how much. So there's three parts to the equation, as I mentioned on page 573. Basically, what is your increase in assets, projected increase in assets? So I've got the equation over here. Projected increase in assets minus spontaneous increase in liabilities minus increase in retained earnings. So basically, if we need to add capacity, basically adding more property, plant, and equipment items to sustain growth, that would be a cost. We have to finance that somehow. As spontaneous liabilities go up, that reduces our need for financing. Think mostly accruals, accounts payable and accruals. And then also, as we generate net income and as we keep our net income and not pay it all out as dividends, that also would provide some internal financing for us. So basically, our cost minus what we're generating in terms of increase in liabilities and increase in retained earnings gives us our AFN. So I've already got this kind of solved for you. I'll walk you through how I got the answers. So the AFN equation itself, then, just to break it down into numbers, is your assets today, the zero means today, divided by sales today, and that number then divided by, or multiplied by, I should say, not divided by, multiplied by your change in sales. And I'm just realizing I don't know why I have a division sign there. Multiplied by your change in sales. Same thing over here. Liabilities today divided by sales today multiplied by the change in sales. Then MS1 is your basically is your margin. M is your margin multiplied by sales a year from now multiplied by the payout ratio. 1 minus payout is your payout ratio. How much of your retained earnings do you keep versus you give away as dividends, or pay out as dividends? You're not giving them away, you're paying them out as dividends. So let's walk through each part of the problem here. And so over here on the left is the problem that I solved on the right. Carlsbad Corp. Sales are expected to increase from 5 million in 16 to 6 million in 17, which is a 20% increase. Assets are 3 million today. They're at full capacity today. Assets must grow in a proportion to projected sales. So a 20% increase in sales means some kind of increase in assets. At the end of 16, current liabilities are $1 million, consisting of $250 of account payable, $500,000 of note payable, $250 of accrued liabilities. Profit margin is forecast to be 3%, and forecasted retention ratio is 30%. So that profit margin is basically that's the very bottom line of the income statement after interest and after tax. That's how much the profits are. So over here on the right hand side, let's go ahead and solve for the problem. So excuse me. So my change in assets is assets today divided by sales today. Assets today are at 3 million right here, and sales are at 5 million. And I multiply that by my change in sales, which is going from 5 million today to 6 million in 17. So I do that and I get 600,000. Then I do my spontaneous increase in liabilities. My liabilities numbers today is, now here's where you have to be very careful, is we're looking at spontaneous liabilities. Current liabilities are $1 million. However, that consists of $250 of accounts payable, $500,000 notes payable, and $250 of accrued liabilities. Spontaneous liabilities are your accounts payable and your accruals, not notes payable. Accounts payable and accruals will just simply go up as you have more sales and production. Notes payable would require an intentional going to a bank and asking for a note and signing some documents, whereas the accounts payable and the accruals will spontaneously increase due to growth of the company. Now, it doesn't mean we won't go out and get more notes payable. We may do that, but it's not spontaneous. The whole point is this is spontaneous. So we only include 500,000 in that number, and we divide that by sales today, the 5 million number. We multiply that by the change in sales. Then we do our increase in retained earnings. That is my M, the margin, is 3%, multiplied by sales a year from now, S1, the $6 million number, the increased sales number, multiplied by the payout ratio, which they said the retention ratio is 0.3. So 1 minus payout is the retention ratio, and so the retention ratio was just given to us essentially as 0.3. So sometimes they may say the dividend ratio is whatever number that is, and you would do 1 minus a dividend ratio, but they just gave us the retention ratio as 0.3. And so the formula is my increase in assets minus liabilities minus retained earnings, and I get 446. So for this company to grow by $1 million worth of sales means they need to go out and finance $446,000. They need to find that somewhere, because essentially their assets have to grow by $600,000, and they got to find the money for that. Internally, they'll generate $154,000. So externally, they have to go out and get $446,000. Okay, so that's question 1. Questions 2 and 3 are just variations of question 1. And it says for question 2, refer to question 1, what additional funds would be needed if the company's year-end assets had been $4 million? Assuming all numbers are the same, and then why is this different? So let's just go ahead and change that one number. So instead of assets being 3 million, we're going to change that to be 4 million. So we're going to go from 446 to a different number. Just by changing that one number, we get 646. So it goes up a lot more. It goes up by 200,000. So basically, that's the capital intensity ratio is what that means. So the capital intensity ratio is just assets today, A0, divided by sales today, S0. And that basically says how much asset does the company need to generate sales, and this would be a higher capital intense company at this level than the previous example that we had. Therefore, they need to have more assets on hand to generate sales. So they need more assets to generate sales than the previous example did, which means they need more financing. Okay, so that's question 2. Question 3 is another variation of the base example. It says refer back to problem 1 and assume the company had 3 million in assets at the end of 16. Now assume the company pays no dividends. And then why would it be different? So let's just kind of look at that from the two perspectives here. So let's go to here. Instead of this being 4 million, we know this will now be 3 million. So let's back this up. We'll go to 3 million. That's going to go down to 446. And then we're going to change the payout ratio. Basically, we're going to say they don't pay out anything. Okay, so they're going to keep everything that they make. So essentially, they're going to keep their own retained earnings. Notice how this goes down to 320. So we need less financing if we keep everything. Okay, so we put this back to the 3 million like it was before in question 1. The only thing we did now was we just said they're going to keep everything. All retained earnings will be kept internally. We'll pay no dividends. Clearly, that reduces the need for financing, right? The less we give away as dividends, the more we can use internally to pay for our growth. And in fact, in a fast-growing company, that's probably what most shareholders would want, is just to say, you know what, keep investing that in the company as long as you can maintain these sales levels, keep selling, invest in property, plant, and equipment to get those sales numbers, and then again, when you've kind of peaked out and you've maintained that sales level that makes sense, and you start to generate cash, you don't need to reinvest as intensely back into the company, then pay out dividends. That's when it kind of makes more sense. So anyway, so that was questions 1, 2, and 3. Hopefully you see that if you set up a good formula here just to kind of do that for you, it becomes really easy to work these. in Excel, and then transfer your numbers into Applia. Okay, there's one more question I want to go over with you, and I've got some stuff here in Excel that I already put there. And this is question 16.7, so let me scroll down to the left to get to that one. And this is the one that's very similar to your required problem. It's in fact pretty much the same setup, the same company. You'll just get different numbers. And so what I've done is I have, oops, and I think I chose the wrong one. That's not 16.7. Oh, I'm sorry, it is 16.7. 16.7. And I actually used the wrong numbers on the right hand side, I'm realizing. So anyway, 16.7, I'll just put in the new numbers that I need. I think I put in the numbers from 16.4. Yes, I did. Okay, so we'll do 16.7 because that one's just like the required problem. So on the right hand side, I just made an Excel file that just copied all the numbers, the same style as the problem itself. I'm just going to type in the right numbers now since I didn't do that very well. So I've got 3 million, except I didn't type that right, and then 2,450,000 for operating cost. My EBIT's 550. This one has depreciation, so I have to add that. So bear with me while I do that. And then depreciation is 250. And then I need to type in EBIT number. And so my EBIT is the 550 minus the 250. Okay, so my EBIT's 300. And then my interest is 125. Therefore, my EBT, let me type that in, is, whoops, I got that. Make sure my formula is right. It's not right. There we go. Is 175. My tax is 40% of the 175. My net income is 105. Okay, so that's where I'm at. And then, looking at the problem on the lower left, it says, here's basically today. Here's where we're at today. And it says, looking ahead to the next year, we're going to make some changes, make some estimates. Year-end sales are expected to be 10% higher than the $3 billion in sales generated before. Year-end operating costs, excluding depreciation, are going to be 80% of year-end sales. Depreciation will increase at the same rate as sales. Interest costs are expected to remain unchanged. The tax will also be 40%. Let's forecast our net income for the next year. So really, once you set this up, and I already added the formulas, it's just a lot of adding and subtracting to do these. So really, my suggestion would be just open an Excel file up and just see if you can't just mimic this that's already here using the proper formulas also. And I like underlining too, just to make sure that you can see everything exactly the right way. Let me make this bigger here so I can get to the right icon. And let me just do the bottom border. I like that better. Okay, so let me minimize that again. And so all I did was copy on the right hand side exactly what you see on the left hand side. So they're exactly the same. And then we're going to look at the forecast here, and the forecast says sales will be 1.1% or 10% higher, which is 1.1. So I'm going to type in 1.1. And then it says next, year-end operating cost, excluding depreciation, will be 80% of year-end sales. So I'll type in 0.8. And excuse me. And everything else is pretty much going to stay the same. So to do my forecast from my base year to my future year, let's start with sales. Everything really becomes a percent of sales. That's really kind of what you have to do first, is you have to have a good sales number. So we're basically saying sales will go up by 10%. So I'm multiplying my 3 million times, which is actually billions, times 1.1 to get 3,300,000. Then operating costs are 80% of sales. Okay, so that just says 0.8, but that's of sales. So I can just do plus my sales number, multiply that by 0.8, and I get my cost of goods sold number. Then my EBIT is just simply sales minus my cost of goods sold, which is my operating cost. Okay, I get 660. Depreciation, it says here, is expected to increase in the same rate as sales. So I'm going to type in a 1.1 because it's increasing at 10%, just like sales did. So I'm going to just basically take my 250 and just multiply it also by the 1.1, and I get 275. My EBIT, which actually this is actually EBITDA up here. Let me get that right so I'm not confused. That's EBITDA, then EBIT. So my EBIT is just simply the 660 minus the 275. Okay, and then that's 385. My interest, it says, did not change. Over here on the left it says interest cost will be unchanged, so just type in 125. So my EBIT, or my EBT I should say, is the 385 minus the 125, and I get 260. My tax is 40%, so I can take my EBT, multiply it by 0.4, and I get 104. My net income then is the 260 minus the 104, and I get 156. Okay. Now this one didn't ask for dividends. I had done another problem that did ask for dividends. If it asked for dividends, though, let's just say, for example, if it asked for dividends, you can just find out, you can just basically take the net income number multiplied by your dividend percent, which in this example is 0.3333, and then the formula down here would just simply be your net income minus the dividends as your addition to retained earnings. Okay, this one did not ask for that, but I just set that up. But anyway, that's how you do this problem. I don't think it's too tough. If you just set this up in Excel, I think it becomes really easy to do. One more thing I wanted to show you. This is just the Chapter 16 textbook Excel that I had open. And let me just go to the top of the first tab, the AFN tab. This does a good job of just walking you through an AFN example. Of course, this is the same thing that's in your book. They just take a slice and dice of the same file and put it into your ebook. But sometimes it's easier just to come down and look at these, and it's kind of good to look at the formula sometimes and just see how they're building these formulas. So the actual AFN formula, the explanation is down here, and they plug in, they do the description of it right here, and they put in the little symbols there to symbolize the description, and they plug in the numbers right here. They get you the three parts of it, and they do the AFN right there. Okay, so that's, I think, very helpful to take a look at. The forecast is right here. This forecast is more complicated than the required problem one. It has more parts to it. It's essentially the same thing, though. Basically, they've got adjustable inputs and fixed inputs, and then they do kind of the base case, the change, and the projection, just like I did with you. I kind of did the same thing. So this is exactly what I did with you in the income statement. We were not asked to do a balance sheet, but if you want to take a look at a balance sheet, and you can just kind of follow this as an example also. And also, they also show us earnings per share and a whole bunch of ratio stuff there too. So if you want to take a look at that, it's all right there for you to take a look at. But otherwise, I think you'll find the 16 problems to be a little bit easier than other chapters. Hopefully, it's not a tough chapter. But it's good. It's a good final chapter to do because it kind of takes a lot of the work we've done throughout the semester and kind of summarizes it into this chapter in terms of, now that we kind of have a good understanding of finance, how do we use those concepts to project growth, project funds needed, and some things like that. And as always, if you